Listen up. If you've been stacking silver for the past few years and you're sitting on gains right now, congratulations. You played the move. But here's the part nobody's talking about loud enough. When you sell, the IRS doesn't treat your silver like a stock. They treat it like a baseball card. And that distinction could cost you an extra 8% of your profit. Money that should be in your pocket, not theirs. So today, I'm walking you through the 2026 silver tax bomb that's sitting in the fine print of the tax code, how it works, why it exists, and most importantly, the legal strategies you can use right now to minimize the damage before you ever hit the sell button. Because here's the truth. Profits you can't keep aren't profits. They're just numbers on a screen that make you feel rich until tax season arrives and reminds you who actually has the final say. So stick around. This one could save you thousands or tens of thousands, depending on how much metal you're holding. Let's start with the basics, because this is where most people get blindsided. When you sell stocks, bonds, or ETFs, your gains are taxed as capital gains. If you held for more than a year, you pay the long-term capital gains rate, which for most people sits at 15%. High earners might pay 20%, but the majority of middle-class investors are in that 15% bracket. But physical gold, silver, platinum, and palladium? The IRS classifies them as collectibles. That puts them in the same tax category as art, antiques, stamps, coins, and vintage wine. And collectibles are taxed at a maximum rate of 28%, nearly double what you'd pay on a tech stock or a dividend-paying ETF. Now, if you're in a lower tax bracket, say the 22% or 24% federal bracket, you'll pay your ordinary income rate on short-term gains and up to 28% on long-term collectibles gains. But if you're in a higher bracket, that 28% ceiling is the number you need to plan for. Here's what that looks like in real dollars. Let's say you bought 1,000 ounces of silver at $25 per ounce back in 2023. You spent $25,000. Now it's early 2026, and silver is sitting around $85 per ounce. You decide to sell. Your position is worth $85,000. That's a $60,000 gain. If silver were taxed like a stock at 15%, you'd owe $9,000 in federal tax. You walk away with $51,000 net profit after tax. But because it's a collectible, the IRS wants 28%. That's $16,800 in federal tax. You walk away with $43,200 net profit. That's a $7,800 difference. Same metal, same gain, different tax treatment. And that $7,800 is gone. Not because you made a bad trade, but because you didn't structure the exit correctly. And we haven't even talked about state taxes yet. If you're in California, New York, or another high-tax state, add another 5% to 13% on top of that federal bill. Suddenly, you're looking at a combined rate that can push close to 40% of your gains going to taxes. That's not wealth building. That's wealth transfer. Now, you might be asking, why does the IRS treat silver like a baseball card in the first place? The short answer is, because they can. The longer answer is that the collectibles tax was designed decades ago to capture gains on luxury assets. Things rich people bought, held, and sold at auction for huge markups. Rare art. Vintage cars, gold coins with numismatic value. But here's the problem. The definition didn't get updated for modern precious metals investing. When you buy a silver eagle or a 100-ounce bar, you're not buying it for its collectible value. You're buying it as a store of value, a hedge against currency debasement, an inflation-resistant asset. It's a financial decision, not a hobby. But the IRS doesn't care about your intention. They care about the category. And physical precious metals fall into Section 408M of the tax code, which defines collectibles for IRA purposes, and by extension, capital gains treatment. So even though you're behaving like an investor, the tax code treats you like a collector. And that's the trap. Now, why am I calling this the 2026 tax bomb specifically? 3 reasons. Reason 1, the maturity of the silver bull market. A lot of people started buying silver in 2020, 2021, and 2022 when it was in the $20 to $30 range. Fast forward to 2026, and we've seen silver push toward $90 and consolidate in the $70 to $85 range. That's a 3x to 4x return for early buyers. And as silver hits these psychological levels, $100, $120, wherever your personal exit zone is, more and more people are going to start selling. They're going to lock in profits. And when they do, they're going to trigger that 28% collectibles tax, often without even realizing it until they file in 2027. That's when the shock hits. That's when the emails start. Wait, I thought I only owed 15%. No, you owed 28%. And now you're scrambling to cover the bill. Reason 2. The tax code isn't changing. There's been talk for years about reforming the collectibles tax, especially as more Americans move into physical precious metals. But as of early 2026, nothing has passed. The 28% rate is still on the books. And with federal deficits running hot and the IRS under pressure to boost revenue, don't expect them to give you a break. If anything, enforcement is getting tighter. The IRS has been ramping up reporting requirements for bullion dealers. Form 1099-B filings are expanding. They know more people are holding metal and they want their cut. Reason 3. State-level tax changes. Several states have started eliminating sales tax on precious metals purchases, which is great for buyers. But that doesn't change the capital gains picture. And in states like California, which just raised top income tax brackets again, the combined federal plus state hit on collectibles gains can now exceed 38% to 40%. So the 2026 tax bomb isn't a single explosion. It's a convergence. A mature bull market, unchanged federal tax treatment, and rising state tax burdens all colliding at the same time. All right, now that you understand the problem, let's talk about the solution. I'm going to give you a 4-layer strategy to legally reduce or defer the collectibles tax. These aren't loopholes. These are legitimate tax planning tools that anyone can use if they structure things correctly. Layer 1. Use a self-directed IRA or 401k. Here's the first move, and it's the most powerful. Hold your silver inside a tax-advantaged retirement account. Most people don't realize you can hold physical precious metals in an IRA. But you can, through what's called a self-directed IRA (STIRA), with a custodian that allows precious metals. Here's how it works. You open a self-directed IRA with a custodian like Equity Trust, Kingdom Trust, or one of the other major players. You fund the account, either by rolling over an existing IRA or 401k, or by making annual contributions. Then you direct the custodian to purchase IRS-approved bullion on your behalf. That means American Silver Eagles, Canadian Maple Leafs, or bars from approved refiners that meet the .999 fineness standard. The metal is stored in an approved depository, not in your home safe. That's the trade-off. You don't have physical possession. But in exchange, all gains inside that IRA grow tax-deferred, traditional IRA, or tax-free, Roth IRA. So if you buy silver at $30 inside a Roth IRA and it goes to $100, you pay zero tax on that $70 gain when you eventually withdraw in retirement, as long as you follow the rules. Zero. Not 28%. Not 15%. Zero. That's the single biggest advantage of the STIRA structure. You completely sidestep the collectibles tax. Now, the downsides. You can't take physical possession until you retire or you pay penalties. You have to use an approved custodian and depository, which means annual fees, typically $200 to $500 per year. Contribution limits apply, $7,000 per year for 2026 if you're under 50, $8,000 if you're 50 plus. But if you're planning to hold silver as a long-term store of value and you don't need liquidity right now, this is the most tax-efficient structure available. Layer 2. Offset gains with tax loss harvesting. If you're holding silver outside a retirement account, the next best tool is tax loss harvesting. Here's the concept. If you sell your silver and realize a $60,000 gain, that gain can be offset by losses from other investments. Let's say you also hold some mining stocks that didn't perform, or a crypto position that's underwater, or even an ETF that's down for the year. If you sell those at a loss, you can use those losses to offset your silver gains dollar for dollar, up to certain limits. In fact, capital losses can offset capital gains fully, and if you have excess losses, you can deduct up to $3,000 per year against ordinary income, and carry forward the rest indefinitely. So the move is this. In the same tax year that you sell your silver, look at your portfolio and ask, what's underperforming? Harvest those losses strategically. Use them to shield your silver gains. This doesn't eliminate the collectibles tax, it just reduces the taxable base. But if you can cut your taxable gain from $60,000 down to $40,000 or $30,000, you've just saved thousands in tax. Layer 3. Time your sale across multiple tax years. Remember what I said about the gold to silver ratio exit strategy. This is where it ties into tax planning. Instead of selling your entire position in one shot, say December 2026, scale out over multiple years. Sell 25% in 2026. Another 25% in 2027. Another batch in 2028. Spread it out. Why? Because capital gains are taxed annually. If you realize $60,000 of gains in 1 year, you pay 28% on $60,000. But if you realize $20,000 per year over 3 years, you still pay 28%. But you might stay in a lower overall tax bracket for ordinary income, avoid triggering additional Medicare surtaxes, and preserve eligibility for certain deductions and credits that phase out at higher income levels. Plus, spreading the sale gives you more flexibility. If tax laws change, if silver dips and you want to re-enter, if your personal financial situation shifts, you have optionality. One sale equals one decision. Multiple sales equals multiple decision points. Layer 4. Consider a 1031-like exchange, with caveats. Now, this one is tricky, and I want to be very clear. Section 1031-like-kind exchanges do not apply to precious metals anymore as of the 2017 Tax Cuts and Jobs Act. That loophole was closed. But here's what you can do. Rotate from physical metal into mining equities, royalty companies, or precious metals ETFs without triggering a taxable event in certain retirement account structures, or by reinvesting proceeds into assets that align with your long-term thesis. For example, let's say you sell your physical silver and realize a $60,000 gain. You pay the tax, but instead of spending that cash, you immediately reinvest into a basket of silver mining stocks like First Majestic, Pan American Silver, or a streaming company like Wheaton Precious Metals. Those equities are taxed as capital gains at 15%, not 28%. So going forward, future appreciation is taxed more favorably. You've essentially upgraded your tax treatment by shifting from physical to paper. The downside? You lose the tangibility. You lose the insurance aspect of physical metal. And you introduce company-specific risk and market correlation. But if your goal is to stay exposed to silver's upside while improving tax efficiency, this rotation strategy can make sense for a portion of your stack. Alright, quick detour. Let's talk about reporting requirements because this is where a lot of people get tripped up. When you buy silver, there's generally no reporting to the IRS unless you're paying with more than $10,000 in cash, which triggers a Form 8300 from the dealer. But when you sell, the rules change. Dealers are required to file Form 1099-B with the IRS for certain types and quantities of metals. Specifically, sales of 25 or more ounces of gold eagles, maple leafs, or Krugerrand sales of 1,000 or more ounces of silver eagles or maple leaf sales of any quantity of 100-ounce silver bars, 1,000-ounce silver bars, or 1 kilo gold bars. If your sale hits one of those thresholds, the dealer files a 1099-B. The IRS gets a copy. You get a copy. And now the IRS knows you sold metal and they'll be looking for that gain on your tax return. If you don't report it, you're asking for an audit. And if they catch it, you're not just paying the tax, you're paying penalties and interest on top. Now, does that mean you should only sell in quantities under the reporting threshold to avoid 1,099s? Technically, some people try that strategy. They sell 999 ounces of silver eagles instead of 1,000. They spread sales across multiple dealers. They avoid the trigger. But here's the thing, you're still legally required to report the gain on your tax return, whether or not you get a 1099. The IRS doesn't care if the dealer didn't file a form. If you had a capital gain, you owe tax. Period. Trying to hide it is tax evasion, not tax avoidance. And with the IRS ramping up enforcement and using AI-powered audits to flag unreported income, that's not a risk worth taking. So my advice, assume everything is reported. Plan your taxes as if the IRS already knows. Use the legal strategies I just gave you. Don't play games with reporting thresholds. Now let's talk about the state-level wildcard because this is where the pain can really multiply. Federal collectibles tax is 28%. But depending on where you live, your state might add another 5% to 13% on top of that. Here's a quick breakdown of the worst states for precious metals taxation. California, top rate of 13.3%. Combined with federal, you're looking at 41.3% of your gain gone. New York, top rate of 10.9%. Combined, 38.9%. New Jersey, top rate of 10.75%. Combined, 38.75%. Oregon, top rate of 9.9%. Combined, 37.9%. Minnesota, DC, Hawaii, all in the 9% to 11% range. Now, contrast that with states that have no state income tax. Texas, Florida, Nevada, Washington, Tennessee, Wyoming, South Dakota, Alaska, New Hampshire. No tax on earned income, but does tax interest/dividends. If you live in one of those states, you're only paying the 28% federal rate. That's it. No state add-on. So here's the strategy some people use. Establish residency in a no-income tax state before selling. I'm not a lawyer, and this isn't legal advice. But if you're sitting on a massive silver gain and you live in California, and you were already thinking about moving to Texas for other reasons, well, moving before you sell could save you 13% of your gain. That's a six-figure decision for some people. But you have to do it correctly. You need to establish domicile, driver's license, voter registration, physical presence for most of the year. You can't just rent a mailbox in Nevada and call it a day. The state you're leaving will challenge you if the numbers are big enough. So if this is something you're considering, talk to a CPA and a tax attorney who specialize in state residency planning. But know that it is a legal option, and it's one that high-net-worth individuals use all the time. Alright, let's bring this full circle with 3 scenarios for how to think about timing your silver sale in 2026, depending on where the market is. Scenario 1. Silver consolidates in the $70 to $90 range. If silver stays range-bound through mid-2026, this is your best window for tax planning. You have time. You're not being forced out by a blow-off top or a crash. You can methodically execute, open a self-directed IRA and start shifting future purchases into that account. Harvest tax losses from other positions to offset a partial sale. Scale out 20% to 30% of your physical stack, locking in gains while the market is calm. Use the proceeds to rotate into mining equities or ETFs taxed at 15%. This is the disciplined, boring, high-tax efficiency approach. And boring wins. Scenario 2. Silver spikes to $100 plus in a blow-off move. If silver suddenly rips to $100, $110, $120 on the back of a supply shock, a currency crisis, or a massive institutional bid, you're in a different situation. Now, urgency overrides tax optimization. Yes, you'll pay 28%. Yes, it hurts. But if silver goes parabolic and you know the move is unsustainable, take the tax hit and lock in the gain. Don't let the tax tail wag the investment dog. A 28% tax on a $100,000 gain is $28,000. You still walk away with $72,000. That's better than holding through a 50% crash trying to save on taxes and watching your $100,000 gain turn into a $50,000 gain. In a blow-off scenario, sell first, optimize taxes second. But even then, you can still spread the sale across December 2026 and January 2027 to split the gain across 2 tax years. Harvest losses in the same year to offset. Move the proceeds into a Roth IRA through a conversion, if eligible, to shield future gains. Scenario 3. Silver pulls back to $50 to $60. If we get a sharp correction, maybe policy changes, margin hikes, a temporary dollar rally, and silver falls back toward $50 or $60, this is your reaccumulation zone. Don't sell. Wait, if your cost basis is $25 to $30, you're still up, but the risk-reward of realizing gains in a pullback is poor. Better to hold your physical stack. Use the dip to add to your IRA position at lower prices. Position for the next leg up, which historically comes after corrections shake out weak hands. And remember, you don't owe tax until you sell. Unrealized gains are tax-free. Alright, Let's build your personal decision tree. Write this down or screenshot it. Step 1. Decide your exit price or ratio. Are you selling at a dollar target? $100? $120? Are you selling at a gold to silver ratio? GSR 50? GSR 40? Are you selling based on a date? End of 2026? Mid 2027? Lock that in. Put it in writing. Because tax planning starts with knowing when the taxable event will occur. Step 2. Calculate your expected gain and tax bill. Take your silver position. Subtract your cost basis. Multiply by 0.28 for federal, then add your state rate. For example, position value, $100,000 cost basis, $30,000 gain, $70,000 federal tax, 28% $19,600 state tax, e.g., 8% $5,600 total tax, $25,200. Now you know the number. You're not guessing. You're planning. Step 3. Choose your avoidance layer. Which of the 4 strategies can you use right now? Can you move future buys into an IRA? Do it. Can you harvest losses this year? Do it. Can you split your sale across 2 years? Plan it. Can you rotate some metal into mining stocks? Consider it. Pick at least one. Ideally, combine 2 or 3. Step 4. Execute and document. When you sell, keep every receipt, every 1099-B, every trade confirmation, every basis record from when you originally bought. If the IRS audits you, your defense is documentation. Show them the purchase invoices. Show them the sale confirmations. Show them the math. And if you used a strategy like tax loss harvesting or an IRA rollover, have your CPA document the justification and keep it in your tax file. The IRS doesn't go after people who can defend their numbers. They go after people who wing it. 31:00. What if you already sold? Quick note. What if you already sold silver in 2025 or early 2026 and didn't plan for this? You still have options. Option 1. Harvest losses before year-end. If you sold in 2026 and you're filing taxes in April 2027, you have until December 31st, 2026 to harvest offsetting losses. Look at your portfolio. Find the losers. Sell them. Offset the silver gain. Option 2. Make an IRA contribution. If you're eligible, you can contribute to a traditional IRA up until tax day, April 15th, 2027, and deduct the contribution, which lowers your taxable income. That won't reduce the capital gain itself, but it can reduce your overall tax burden and effective rate. Option 3. Pay the tax and move on. Sometimes the answer is just to pay it. Yes, 28% stings. But if you made a big gain and you didn't plan ahead, pay the tax and use it as a learning experience for next time. Trying to dodge the IRS after the sale is where people get in trouble. Pay the bill. Document everything. And next time, plan ahead. Alright, let's zoom out for a second. This video isn't just about saving money on taxes, though that's important. It's about keeping the wealth you build. One of the biggest mistakes investors make is focusing only on the upside. They obsess over entry points, price targets, and narrative catalysts. But they ignore the exit mechanics, the taxes, the liquidity, the timing, the structure. And then when it's time to sell, they get hammered. They lose 28%, 35%, 40% to taxes that could have been reduced or deferred with basic planning. Here's the truth. The IRS is your silent partner in every investment. They don't help you buy. They don't help you hold. But they're always there when you sell. And if you don't plan for them, they take more than their fair share. So treat tax planning like you treat position sizing. It's not optional. It's not boring. It's essential. Because at the end of the day, the only number that matters is the after-tax, after-fee in your bank account number. Everything else is just a story you tell yourself to feel smart. Alright, here's your action plan. This week, 1. Calculate your current silver position and cost basis. Know your numbers. 2. Estimate your tax bill at 28% federal plus your state rate. Write it down. 3. Research self-directed IRA custodians if you want to move future purchases into a tax-advantaged account. This month. 4. Review your portfolio for tax loss harvesting opportunities. What's down that you can sell? 5. Talk to a CPA or tax advisor who understands precious metals and collectibles tax. Get a second opinion on your strategy. This quarter. 6. Execute at least one tax minimization move. Open the IRA, harvest the losses, or plan your multi-year sales schedule. And if you found this video helpful, do me a favor. Comment 28% tax trap below so I know you're locked in and paying attention. I read every comment, and I use your feedback to decide what videos to make next. If you want faster updates on silver, tax strategies, and macro breakdowns that I don't always post here, join my premium WhatsApp channel. Link is in the description. That's where I drop voice notes, quick charts, and real-time alerts when things move fast. And if you're serious about protecting your silver gains from the tax bomb, subscribe to this channel and hit the notification bell, because the IRS isn't going to warn you. The bullion dealers aren't going to warn you, but I will. The 2026 silver tax bomb is real. The 28% rate is locked in. But with the right strategy, you can legally cut that bill in half or eliminate it entirely. Don't let tax ignorance steal your silver profits. Plan now. Execute smart. Keep what you earn. I'll see you in the next one.